Welcome to the show, everyone. I am Groot. No, I am not Groot. I am Max. RHMax channel. Boom! Today, I'm excited. We got a couple heavy hitters on the show. We got AxisAlive, and we get to introduce the Contrarian. First time on the RHMax channel. They have a presentation that we'll be going through on macros and talk about markets and just all kinds of good stuff. I had a community post where I asked if you all had any questions. I had a few answers on that, so I'll put your community questions in the doc as well, so we can get through that, talking about some different charts. We'll be going through BTC, HEX, Hedron, Icosa, PLSD, to name a few. If there's any other ones within the Richard Heart ecosystem, please keep it within those that you want us to go over. Drop in the chat. We'll see if we can do it if we have time. But yeah, it should be a good show. I'm excited to get into it. Me and Axis talked about this about maybe a week ago or so, and I didn't know what exactly we were going to talk about until a couple days ago when we really got into planning. But yeah, it's be a good show. We got what's up, Chad? The Donner Swans has entered the chat. You've entered the show. You've entered the Twilight Zone, sir. Welcome. Yeah, shout out Tea Times here. Share the link. Tag me, Axis. I don't know if the Contrarian has Twitter, but if he does, and you know it, tag him as well. Yeah, let's get some people in here, get some good questions going. And yeah, Hex Squid, what's up? I love the squids. I love the dolphins. I love the whales. We win together, so it should be fun. All right, let's get into it. Without further ado, welcome back to the show, AxisAlive.
Hey man, thanks for having me.
Of course, anytime. And introducing the Contrarian. Welcome to the show.
Hey, how are you doing? Hi, everybody.
Doing fantastic. You two gentlemen are going to gonna bring a banger to the show today. So I'm excited.
I think so.
I was a little sleepy, but now I'm caffeinated, and you two showed up. So you've completed the day already. You don't need to do anything. Just we can just chit chat. But I imagine you have more to talk about than that. So
yeah, sure.
Anytime you want me to share the screen, I can. Just let me know.
Well, I mean, just firstly, thanks for having me back on the show. This would be Bob or the Contrarian's very first ever live stream to an audience. So I mean, we do private sessions inside of our private Discord.
Ooh.
But
maybe I saw somebody else the other day. Then I thought I saw you guys the other day. Maybe
we do our private shows for a small group, but would be his first major debut, I would suppose. And Bob's been in the markets for over 35 years, probably pushing 40 years now. He traded commodities at the CBOE in Chicago Board of Exchange. He managed the risk side of the portfolio, trading commodities for professionally for many years, and so he is no stranger to risk and volatility, and so that molds well with the cryptocurrency space, and that is kind of where our friendship was kindled from. And so we decided, over the past few years of him nagging me over and over that we should maybe push the bar a little bit, that we could get together and work on something a little bit bigger and broader and try to educate just everybody who wants to tune in about, what markets are all about and how to read them and the seasonalities of these things. So this morning we just decided to put together 25 slides of what's going on in the macro economy right now. And then toward the end of the presentation, we'll pull it into cryptocurrency and what that means for cryptocurrency in the short and midterm. So I don't know, Bob, if you wanted to have anything else to add to that.
Yeah, that was a pretty good obituary. No, I just want to say thank you.
Don't go yet, Bob. Don't go yet. We need you.
Yeah. Thank you. I'm just. It's pretty unique that AxisAlive and I have gotten together, and just our friendship has bloomed into the interest and the passion. And you'll see through my tone of my voice, I'm passionate about this. I started in '83. And I've never looked back, and I've seen a lot of things, 87, 2000. I mean, I've seen a lot of cycles, and I'm just at a point in my life that I'm trying to give back. So my school of hard knocks, I'm hoping, the next generation doesn't have to go through as much as the previous. So, again, I'm here to share what knowledge I've gained over the years and share it with your group, Max.
Awesome. It's awesome. Well, that's what that's the goal of the channel is to, we talk about a lot of products, a lot of things going on around Richard Heart, the ecosystem, markets, crypto. Just be able to give people information from people who know more about it, who have been there, traded the things, held through all the cycles, all that stuff, or made key decisions. So glad to have your expertise on the show today.
Thank you.
And yeah, so
Oh.
before we go into the slides, I would just say add that if there's questions throughout the presentation, feel free to ask, and then pull them in. Max, you can pull them up at any time, and we'll just address the questions.
Boom. Sounds good to me. Everyone in the chat, if you have any questions, just post them, and I'll find an opportune time to throw them up, and we'll address them. Sounds good.
I do see a quick one from Brahim. Brahim, he says, if I'm a HEX holder, will I get free PulseChain? No, you get HEX on the PulseChain when that fork occurs.
Oh, you know what? I answered that question. I was even thinking wrong on that. Yes, do not listen to me. I said if you hold it through the fork. I was thinking PX. I don't know why I said that now. Yes. Good.
Yeah, it could have been. It was kind of an ambiguous question.
Yeah, that's disregard my response on that. Yes, you will. So if you hold HEX through the fork, you will get PX, but you will not get free PulseChain. If you sack for PulseChain, then you'll get PulseChain. Gotta try to hit one out of the park too early on that one. This is easy. Let me just go ahead and get to that. So, anyways, Brahim, if you have any, if that makes sense, let us know. Otherwise, we can talk about it more. So.
Cool.
All right.
Well, without further ado, let's pull this bad boy up.
Yeah.
So, welcome to AxisAlive's dojo. This is normally what would be a daily update that occurs in a private Discord server. For more information on that, you can message 0xBrennan on Twitter. But for today, we decided to give back to the community and go into the deeper side of the macro markets to try to figure out what's going on and when is the money going to start flowing back into cryptocurrency, and what kind of drivers are in the markets that's driving money flows right at this time. So our first slide here, I don't know, Bob, if you want to kick it off. This is kind of what you sent me this morning on four different charts that are all kind of telling a certain story here. Yeah,
and what I just wanted to tell everybody is I'm trying to expand at least what the the environment is of investment world right now. So you've got to look at a lot of indicators that have infected the market from when I primarily are watching the Fed, because the Fed dictates everything. And since COVID, they printed money. And so we're seeing they've had 7 rate hikes this year alone. They're expecting another one at 115 tomorrow, a 50 basis point rise. That'll be it for this year. And they're looking about 25 basis point rise in January. The inflation rate is still, up at 7.7%. Currently, the Fed funds rate are 3.75 to 4%. A year ago, the Fed stated they wanted the Fed funds rate, which is basically the rate that banks get charged from borrowing from the Federal Reserve. A year ago, they said they wanted it up to 3.85. So we're just approaching that range. And the other aspect that the Fed wants is unemployment. By these rate increases, they're trying to basically kill off jobs. And the unemployment rate is at 3.7%. They want it up to 4.5%. So those are some elements, the backdrop. So what's happening with the interest rate increases, the fastest rate in history. And in the mean of where rates have been historically, we're in the mean right now. But the point is, going from negative interest rates at the beginning of this year to where we are right now is too extreme. So all asset classes have to readjust their values based on the cost of money, because for the last 25 years, money's been cheap and it's been leveraged to the max. That's why you're seeing, ripples like FTX and, some of these other businesses that are non-banks. And we'll talk about that a little later. The assets, the liquidity is coming out of all these markets by what the Fed's doing. And so they want to have the economy crash to a point. And what's going to happen, I think, with this backdrop, we can discuss going forward. So go ahead, Mitch, with your next one.
Sure. Yeah, well, and to add into that, so on the chart one, on the upper left chart here, you can see that since this year, that with all of the rate hikes that have occurred since January, we went basically vertical and so that means that the cost of money is rising for banks. So the way this works at the highest level is that the International Bank of Settlements, the highest central banks, print money and lend money to small banks, and that's where you as a retail citizen goes in there and you get your interest rate from, but they're getting their interest rate from a bigger bank than them. So there's always a bigger fish. And the biggest fish is the Fed, and they're the ones that says we're going to raise the cost of money so that we can stop inflation, which means that they can stop prices from rising indefinitely. Because if you had a situation where prices went up forever, you'd never be able to afford food or gas or a house or anything because it would be out of your price range, right? So in theory, from the crypto world, we like that because we're like, oh, I want Bitcoin at $1 so I could watch it go to $100,000 one day. But in a world where that never retraced 85 and 95%, there was never an opportunity for the little fish to get in on that trade and make money themselves.
Again, I think what again, this is just a background. This is what this is a picture of the effects of what the Fed is doing. It went from, again, 2 lakhs of Fed easy money, and now all of a sudden they're slamming the brakes on. And I've said all along, and Mitch can vouch for me. You could see this coming. This was playing very much like 08, and I was through 08, and so there's a lot of similarities, but there's also similarities to the .com bubble in 2000. So it's kind of unique to, been personally involved in both of those events and seeing how this one is definitely different, but there are similarities. And at the end of the day, you got to know that it's just a matter of time before all this works out. That's what's happening now. They're trying to work out the excess in liquidity, and this stems from COVID and shutting the world economy down. You just can't, we were an on-time inventory. Whenever you went out to retail land, the inventory they had was just as amount they needed to supply their clients. But because they shut the world down, nobody had any backup, because when you put excess money in inventory, you're losing money on it. So that's what on-time inventory came about, efficiencies within the system. So, and that's what's funny, this chart here and how Mitch was just stating how money starts at the Fed dictates money flow, but then you got a central bank involved. You got, these city banks and these big boys, then you got regional banks, and then it comes to us. How many markups do you think that money goes through? And especially now with the rate increases. So the amazing thing, I call this blockchain 101. The new technology, the blockchain technology, can eliminate all these middlemen. Think of that. And that's why I like HEX, and we'll talk about that another time. I'm not excited. I haven't been excited about the coin. I've been excited about what they're taking. They're competing against the banking system. So these dynamics, and I bring this up because we'll cover this further in the presentations. Another element of this world we live in is, technology has gotten fat over this cheap money. And they could hire the most talented kids and let them ride their bike on campus and, do whatever they want, but they'd be on the computer 16 hours a day, and they'd pay them as much as they want. They'd burn them out after, 10 years. The kids go rich, but the company benefits. And, there's a lot of dynamics that are going to change. And I think that's one sector that's going to see, it's gotten fat, just like everybody's gotten fat. We've got all this money sitting at home during COVID, and now you unlock the world economy. Everybody wants to, spend, and the logistics aren't there. So this is kind of my backdrop. I've said all along that inflation's going to stay higher for longer, and so are the rates. And that's what the markets aren't anticipating. And now you're starting to see the breaks in it in certain sectors. And
we'll
housing.
Get into that.
Yeah, we'll get into that too. Go ahead.
Yep. All right. So, where better to start than with the US dollar? It's supposed to be the world's reserve currency, still is to this day. But we're seeing a sharp decrease. It's actually an 8.42% drop in a very short period of time on the dollar. Anybody that can understand a trend sees that the dollar has been increasing in value relative to a basket of other nation state currencies since the 2008 bottom, effectively. But every time you see a big spike down, like in the past, like sometime in 09 and let's see, when was this? In 2017, 18, these big spikes down, they have follow through. So what this is telling me is that money is leaving dollars and it's going to go somewhere. So what our job is we're trying to figure out, well, where is the money going? If it's leaving dollars, where is it going? So I have here on the left that there's 23 days left until this monthly candle closes. It's just a tiny little candle. It's pushing up against this upper mid band of this channel. And the question is, does it make a spike higher? Does it go lower? What does it do? Well, only way to know is to go check out what other asset classes the money's going into. So these moves generally have follow through. They're characterized by money moving into defensive positions such as gold or US bonds. So price is attempting to catch that support on that band. So here I have a couple other I guess fractals. They're old fractals from in the past that when the dollar does these 8% breaks, this is the kind of patterns we can expect to see, sort of a fractal forecast with a little bit of a time frame. So in yellow, let's make some hypothetical situations where the dollar does certain things under certain fundamental conditions. Let's say the dollar reverses here, bounces off this level, goes up and tests the 109 level or to the 112 level, somewhere in there by the summer of next year. Well, that would mean that some other asset classes are dumping and that there's still a flight to safety in the dollar. But that would only be short-lived, and you might get like a double or triple top, and then eventually by spring of 2024, you would see finally the capitulation of the dollar into weakness and an asset boom. Also, in purple, we have another fractal that comes off of 8% drops on the dollar historically. That would imply that you get a small bounce that gets completely reversed to new lows and starts trading in a new range somewhere between the 94 level and the 102 level. And these levels are based off this institutional wick here, double wick pattern. And the reason why I think that this is a possibility is because there are certain signals coming in on like gold and bonds and crypto that is showing that there could be a short-term bottom in play before a big spike back toward dollar safety and then finally capitulation.
Yeah, and fundamental being that the Fed's at the end of the rate hikes. That's what the whole thing. People always ask me what came first, technicals or fundamentals. I said, apply the same to the chicken or the egg.
Yeah.
You can always find a fundamental reason for a technical move.
I agree with that.
The dollar, I have support around 103.5 on the March contract and a high of 109.10. So we can back and fill on there because this is going to take some time, like Mitch said, to play out. But I think the dollar has turned, from the upside to, there's a tremendous amount of consolidation if you drew a couple horizontal lines between those, channels. So we could go back again into the channel, into the mean. The question is, what if it doesn't hold it?
Yeah, and so then that's where you get this third red line, which would be something sort of on the premise of dollar destruction, where you see a complete mass exodus from the dollar, foreign governments completely abandoning U.S. sovereign debt, and pretty much just an abandonment of the Fed because of a lack of trust. And I'm pretty sure it was David in there earlier that said, who trusts the Fed anymore, after the things that they do and they say and the insane monetary policies. And so, this is always, you have to be cognizant of that this is a possibility. And if that were to happen, you could see the bottom on crypto, the bottom on some of these other assets quicker, and just a complete exiting from the dollar. So not to say that any one of these three outcomes is going to happen for sure, but just that this is your projected ranges as we ultimately will trend toward the bottom of this uprising channel.
And, that was a great point. It's based on, the only thing that gives value to any asset is what people want to pay for it. And the dollar, since it's off the gold standard since 1974, it's just the faith that our government's going to pay its debt. Speaking of debt, look at the consumer now. They're running historical amounts of debt right now, and all that money, there's still that money still out there, but it's going to be gone in 6 months. So the Fed will have done its job and eliminated the liquidity that it printed up during COVID. But then what's the catalyst going forward?
So here's your money printing chart, Bob, to continue.
Yeah. So, this is a great chart. The chart itself is M2, and that's basically the amount of money that the Fed printed up between COVID. And you could even go back to 08, because there's been 3 events where the Fed has printed money. Again, in 08 to save the banking system. And a lot of people aren't aware of it, but a few years back, it's raising its head right now. is the non-bank investment dollars, and that's
and this comment here, that it's just basically the point is that the Federal Reserve's balance sheet ballooned during 2020, and that's this huge spike in liquidity. And so what the Fed is trying to do right now is as you see that this chart is starting to roll over and go bearish, what that actually is meaning is dollars are being pulled out of the economy. And, where are they going? Well, they're not going into the economy. Okay. They're getting probably de-aided.
What the Fed has done, and that's been their game plan, they were going to start by reducing their book from, again, 08. They had a lot of assets that they said they'd buy and just sit on them. And then when the markets recovered, they'd be able to sell them at a profit. And they did a pretty good job when they started to. However, once they started unloading it, then you had, the next COVID happened. Well, now they got to run the pumps again because of another crisis, and we'll just keep fattening our book up and to keep, people employed. Yep. Again, they've done that so often.
According to this chart here on the left, it's basically saying that as of November 1st of this year, the Fed's balance sheet is $8.68 trillion. That's almost half of the entire liquidity pool of dollars out there. So they are able to backstop in so many ways, and that will become very clear when we look into the bonds charts.
And again, the other aspect you got to keep in mind, the Fed's inflation rate is supposed to be 2%. We're burning at 7.7% now. So what's going to, again, demand destruction is what he's going for. And people just got to, stay, conservative because he wants to shrink this money out there. And it's not going to be pretty. I don't think next year's going to be pretty. That's my personal opinion, because people can't even make up their mind if you're in a recession yet. But it's happening.
We'll have charts. We'll have charts, and when we get to the yield inversion part, that'll prove that a recession is coming. And I just wanted to, we'll pull up this chart or this question here, or this comment from Wake Dog. He says, funny how we had a revolution over 3% tax in the 1700s. Now we're 10x that. When revolution? When's the revolution? And, to answer that question, I don't think that we live in the same United States that we lived in the 1700s. I don't think people really understand how complexified the system has gotten and the truth of how law and finance works. And that's kind of working against us. So we blame each other, we blame some entity, but ultimately we need to come together and understand this stuff. This is why we're doing what we're doing today.
Yeah, AxisAlive. The other thing is, and this is why we met, and what I was driven by is the technology. I'll never forget that, if you don't mind me telling a quick story. I met, AxisAlive at work, and he was a miner. And I'm like, what, you digging for gold? And and he's like, yeah, in a way. And then once I found out about it, I'm like, I know what my background was. I'm like, all right, what's the investment opportunity? Because I said, that's a lot of work. And I go, who makes the chips? NVIDIA. I go, well, I'm just going to buy the guy at the top, and then I'll participate in it without, have to work. So I'm a believer.
Max, isn't that what, how does that saying go about buying the pickaxes instead of mining for the gold or whatever?
Yeah. The gold rush, the people that sold the equipment made the money, not the people digging for the gold. So, and that's all we're trying to do. This is what I'm trying to do. You know what? I don't need the whole pie. Just give me a piece. I'll share my information with anybody who's interested. And that's what I like. This information we're providing. Do your own homework. I encourage homework because you got nothing but time now. I'm in crypto too myself. I have positions on, and it's just going to take time to play out. This is what this presentation is about. We're explaining a broad view of the economy and money. At the end, it's about liquidity. And without it, again, FTX, all these other types of explosions we've seen are going to get more intense next year. Because the cost of money has gone up so dramatic. A lot of these techie companies, they're heavily debt financed. So when their debt is up for renewal, they're going to have to lock in at higher rates. And if they don't have the cash flow, they're out of the business. And again, that's the similarity of the .coms. They did the same thing. They were all moving out of garages, going to get into fancy office spaces because the internet was taking off, Y2K, and
all that Yeah, exactly. I think that those cash flows come from innovation. They don't come from making a new iPhone that does the same thing every year. They don't
No,
come
no,
from Facebook, which is a platform that's been around for over a decade now and hasn't really innovated in any meaningful ways recently.
yeah, but
So it's
it gets back to also how the government perceives how to handle, how to take care of us. Because of Y2K, they really, I know we got some younger viewers there, but people thought every computer was going to crash as soon
yeah,
as we went from 1999
I
to
remember it.
2000. It had never been
I do
tested
too.
or anything. And so the year
Max and I
before,
were still in 5th grade.
yeah. So get this. Before, everybody was coming up with all these consulting firms to make sure your software, your computers will reboot January, New Year's, and the amount, and the Fed was worried. So they, again, pumped money into the economy just to make people feel good because everybody was panicking. Businesses were spending all this extra money just in case. Think about it. If their systems went down tomorrow, you have chaos. So that's what the real fear was in 2000. And then when nothing happened, everybody's like, what the hell did I just spend all this money
And
for?
what it really was a lack of education and a lack of understanding technology. And that's
But
ultimately
technology was at its infancy, Mitch. That's what I'm telling you. And that's what
Yeah.
I've said. There was a lot of stocks that were high flyers, just like, these crypto coins. And at the end of the day, my question to anybody who questions that, yeah, it was a terrible time, but is the internet still here? Because they were saying the internet's gone after the .com. And that's BS. And the same thing with this crypto. What it's doing, and we just demonstrated in the process of not only government releasing information and everything else, why not do it again in a blockchain scenario where everybody gets it at the same time, nobody can regulate it, and there'll be better efficiencies. But I'll get off my tangent.
Yeah, no, this is a good point here by PulseChain Trainer. He asked the question, if quantitative tightening ends and quantitative easing gets turned back on, do you still feel the recession will carry through 2023?
Yes. I'm even looking till almost the second half of 2024. We've had, just look back in the last 4 years, we've had phenomenons that, are historic in nature, from, again, locking, world down to printing endless amounts of money to encouraging, just think when we all opened, it wasn't just the consumer, it was businesses, it was governments, and you just can't drain a system that fast. We're a world. I mean, it takes time, the logistics to move stuff. And that's why inflation was a guarantee. And it's not going to go down. I personally believe that this is not an issue that the Fed can fix. They got a lot of creditability issues.
This chart here is going to try to explain what Bob's saying. And when you see these huge sections of lots of red candles pushing down quickly, those are massive inflation periods of history. So this was in the 80s. This was after the dot-com bubble. And most recently was the COVID. So what this chart measures is the value of the dollar relative to the supply. So when the supply gets increased at a rapid rate, you get massive inflation. And so then this stuff takes time to work through the system. That's what these sideways, and I'll pull up this chart now, these sideways arching parabolas, these are the times when inflation's trying to recorrect. And this is when policymakers, maybe raise interest rates or increase taxes or use one of the levers of the Fed power to try to fix the inflation problem that you see during these huge green spike downs. So we most recently went through a huge green spike down, and what this is trying to predict is how long could this period of recovery take? And this is saying that this is till 2030 at least, and that can just be that's like a time frame. Roughly.
You're optimistic. You call that a recovery. I said, how long until it bottoms is what I would say.
Yeah.
But yeah.
Well, this chart never bottomed.
Yeah. I mean, it's exceptionally lower. You know what I'm saying?
Yeah. Well, my point is that the dollar's doomed and the Fed's doomed to always have to print money. So we're trying to find where are the safe plays, where's the technology, where's the innovation, where can we hedge and save ourselves and be defensive in these times. And so now we'll get into the basically the bond market and again to explain, where's the money going? We showed you how the dollar was reversing. Where's the money going? So I just
not only where it's going. I would say the other indicator that this is going to let you know about is just how severe and historic these events that we're in right now are going to take time to play out. I mean, that's what I want to put in perspective, that people are going to be scared when some of this stuff comes to fruition, like people get laid off. Again, it's already happening in the housing market. Building construction and new permits are down like 30% already. So it's going to have a devastating impact on more sectors as we go.
I just noticed something by looking at this chart, and I just want to point your attention here. If you see down here at the bottom where my cursor is circling 2014, that's roughly when Bitcoin topped and started its bear market. And if you notice, the dollar plus supply rose during the time of a crypto bear market. And then when it peaked, it was actually the bottom of the crypto bear market on Bitcoin. And Bitcoin created its giant parabola run up from $200 to $20,000 in 3 years. And if it's funny because it's an inverse relationship between what this chart's doing and what Bitcoin was doing at that time.
Well, so again, that's true with a lot of asset classes.
Sure, I'm just using Bitcoin as an example. Yep. Yeah. During this time, money flows back into assets, is my point.
Yeah.
We were to the top of the channel here, and it's made its first red candle. And so I'm of the belief that we're in for a very volatile 2023 and into 2024. And then as the inflation metrics correct and pricing gets back to baseline levels, that's when you start to see money flow back into assets.
Yeah.
So I'm getting like a 2-year time frame roughly.
Yeah, because in essence, if you look at it, it's, what the governments are doing is now when everything opens up again, because China's coming online again, that demand's going to be restricted by the cost of money. So that's why they're regulating it. And again, look at the dynamics from COVID, everybody opening and going with all this money. You had to regulate it. It's got to be regulated. It's just like, unclogging the toilet, right? You get the heavy stuff out of the way, and then you're bad analogy.
Running water again. Yeah.
Flush, and pray.
So what is a yield curve? Well, a yield curve graphs the relationship between the bond yields and the bond maturity. So the way bonds work is you can purchase a bond from the government, basically on a monthly, quarterly, bi-yearly, yearly, 2-year, 10-year, 30-year. You can buy these bonds that mature at a different rate, but the reason why you buy the bond is because it pays you to hold it. Just in the same way that HEX, when you stake it, pays you to hold it. But in this system, the U.S. bond system, each type of note gives you a different yield. So a 2-year yield might be 4-point-some% right now, and a 10-year yield might be 3.7% right now. But what that is it's inverse of what it should be. In the same way that Richard Hart created HEX so that the longer you stake, the more you earn, it guarantees that there is no yield inversion into the system, which is not a guarantee in the Federal Reserve System because that system does invert in its yields. And there are periods of history where they have to go into rate hiking and other sorts of levers of the Fed, the power that they have to try to correct that yield inversion. So
an inverted yield curve basically represents a dysfunction in the credit markets. Generally, you want to be paid more for the future of money because, like we said earlier, future dollars are worth less than today's dollars. So that's how they compensate it with interest rates. But again, the longer the lockup period, the maturity period is, the higher the rate. That's the normal economy. Now that it's inverted, nobody wants to take the risk that far out. So they move to the short end of the yield curve. And that's why, your 2 years right now are at 4.4%. And the 10s are 3.6, and then the 30 years are 3.52. So it doesn't make sense. Why would I lock my money up for 30 years and make less on it? So that's what's meant by an inverted yield curve. It's back-assward. And what it means, though,
here it is on the left here. We can see that, okay, on the bottom axis, you have a 1-month note, 3-month note, 1 year, 2 year, 3 year, 5 year, 7 year, 10 year, 20 year, 30 year. What this chart should show, it should be like a parabola, so that the longer you lock your money up with the Fed, the more yield you're going to get for taking more risk and putting your money out into the future.
And let me expand on something really quick. It's just not government bond. Any debt is structured this way: corporate debt, municipal bond debt. That's the principle. The tie-up period represents higher rate of return.
So if I go into the bank and I want to buy a house and I want to get like a 30-year fixed mortgage rate, they'll fix it at a lower rate than if I do a 7-year mortgage rate, right? Theoretically under proper economic conditions. Am I right about that?
Say that again.
If I go to the bank and I want to buy a house,
Yeah.
and if I do a 30-year fix, the interest rate should be lower than if I go and want to do like a 5-year.
The interest rate will probably, yeah, well, depending on, how it's structured, but generally, like a 15-year, what happens is you may get a lower rate, but they want more principal paid back because you're paying it back in less time. You know what I'm saying?
Yep. So there's different variables that plays into this.
Yeah. So you can't just look at it as a differential in that regard.
But for ease of understanding for our viewers, I think it's important to just note here on the left that in the short term, look at how much you're getting paid to lock your money up for 1 year or 2 years, to use just common vernacular of crypto folk. You lock your money up for a couple years in a bond, you're getting paid more than if you lock it up for 30 years. Well, that doesn't sound very good.
The only investor that this benefits since 2000 was the last time seniors could get a positive rate of return on their CDs or T-bills, which is basically an investment in government treasuries for 90 days. You can do 6 months. It's variable maturities. But 2000 was the last time they actually, after taxes, got a positive cash return by investing it. But it was very safe. Again, it was guaranteed. Today, the I bonds, which again has been an instrument that was created since the last inflation, where it actually keeps up with inflation, where other debt doesn't. So these I bonds are paying an incredible rate of return right now. That's guaranteed for, you could buy it for 5 years. So these seniors that need income, that's why I said, depending on what your risk tolerance is and, what your age is, you really have different styles because you're investing for different reasons. Seniors for the last 20 some years were forced into the riskier side of the portfolio because they would either eat up their principal or they could never make as much a return on their investment in typical finance, like bonds, the debt market, they call it, because yields went down from 2000, we went negative interest rates. So on a huge sector, fixed income, got decimated during that if you needed it for income. This is the first time in 22 years that has reversed. So that's pretty huge. And I think that also tells you free money is not coming back. That was the extremes. And I think we're going to go back to the mean. And we all know charts and patterns. You get extreme conditions, but you come back to the mean. And that's where we are in interest rates right now. If we're at 8%, interest rates, that's not historically, that's the mean historically. We just, again, went from negative to where we are now in 8 months, 9 months. That impact on the world economy, shutting it down, it might as well be COVID. That's what I'm seeing in my charts and everything. What we're going to experience next year is going to rattle some.
So, I'm just going to use the mortgage rate chart here for a second to show you guys what he means when he says the mean. Basically, if you found that moving average up here, let's just pull up an average. Let's do like the 1,000-day average. Something. That's too much data. Let's do 500. So yeah, look at this yellow. This is the 500-day moving average over this chart. So we're almost to the mean on that 500-day moving average. But meaning that this middle green line is basically, over the history since 1971, mortgage rates are almost at that middle point.
8%, which was also 8%.
Yeah, which was that key breakdown point that we had in 2000 when we had the dot-com bubble, with everything that went on with that. So, and then this chart here shows like the spread between the treasury yield. So what this is saying is that right now the yield curve is inverted minus 0.82%, and that we haven't been this low on this chart since the 80s when we had the crisis of the 80s. I don't know if you wanted to expand on that quickly. But this inverted yield curve has predicted the past 7 recessions. So we weren't even this low in pre-2008. We weren't this low before the dot-com bubble in 2000, nor were we this low in 89. It was in the early 80s that we had this type of action in the bond market.
Yeah, and can I just interject again I don't know if anybody knows Peter Lynch, but Magellan Fidelity, he's a great guy to read up on because he always just looked around his environment for his investment clues. And during each of these events that you just covered, when you get these huge shifts in again, especially in economies of the world, and I believe that's what's happening now. I remember in the 80s, interest rates in 1977 were 15% short-term rates. And they went from 15 in everybody's businesses like insurance and life insurance. And also if they had a part of them, they come up with policies that invested in the stock market and stuff. But they all assumed the rates would stay high. So when the rates went down to zero, how many of these financial companies lost because they had to made right by the investors because they was sold on promises on again, maps or studies of the last 10 years, but nobody had taken rates to that, low based on the parameters of the data they were looking at. So we've had extreme moves, and I think now we're getting another shift. The shift is it's not free money anymore, and everything's assets got to
free money is represented here in this chart on the black line here. We're between 2010 and then if you take away the few years prior to the 2020 crash, I mean money's been free down here for about a decade, relatively.
I'd say 20 years. Yeah. 20 years.
So I mean, what that means is that
2003.
It comes back to my comment about the zombie economy. What free money does to a society is it makes us weaker, dumber, and less obligated to go out and produce innovation. That's what it does.
It also makes you addicted. Think about it. It's a social thing. You lock people up, you give them all this money. It's money. That's the only, we've been programmed to.
You can't eat money though. You know what I mean?
I understand, but Mitch, again, my culture was growing up. Hey, if you don't feel happy, go shopping, go shop, and now, people have the ability after being locked up for 2 years. I mean, I get it. I think the government was irresponsible by printing money but I understand why they did it, but they didn't do it in 2008. It didn't work. It probably would have worked better in 2008, but that's what they didn't want to have a repeat 2008. So they tried this to print money. I just think the effects of this is going to be worse than what 2008
Well,
did.
They've eroded confidence in the Fed.
Yeah. And that's the scariest thing that's going on now. People are losing faith in the Fed. And if the Fed doesn't have any, political might anymore, again, what is currency? What is an asset? It depends on what we value it worth. And that's why I say it may move out of the hands of people and into systems like, the technology of crypto, I believe.
Yeah.
FTX didn't fail because of crypto. It failed because of a corrupt CEO.
Yeah.
So
over leveraged debt.
Well, it has nothing to do with it. The guy was, I worked in industries where I was in risk management for God's sake.
He was literally taking user funds and using them to trade.
Commingling them. Yeah. He was financing his own hedge fund. He was covering his own position. He was losing his ass on in his hedge fund. Yeah. So anyways, I'll stop.
We got about 15 or 20 minutes more that we can talk on this, and then we'll give you 20 minutes of crypto talk after that because we only got about 35 minutes left. So let's shift the gears here a little bit. We'll talk quickly about commodities and what that means for as far as like money flows. So commodities are like oil, gold, copper. These things are, I think, part of the economy in a large way, $1 trillion asset classes. And so this Bloomberg Commodity Index is an index that's put together to show you like what is the overall market saying about commodity prices. So like if oil price is cheap, it means that you can fill your car up for less money, which means you have more expendable income when it comes paycheck time to purchase risk assets, to purchase goods and services. So when things are expensive, you have less money to spend, especially when the liquidity dries up and there's no free money left. So this is showing a weakness in commodity prices and that they're coming down. Here's copper,
which again, that's what the Fed, that's one of the indicators they want, lower commodity prices.
Yeah. Yep. So they raise interest rates to get prices down. Like, how do you kill demand? Yep. You stop people coming in to buy it. So copper is important to look at. There's a 2-week copper futures chart, and you see how it's in this rising wedge. That's typically a bearish pattern. And so that's showing that it might break down, right? And the reason why we look at copper is because it's a leading indicator of industry, of what's going on in industry and whether it's growing or contracting. So it's actually it's showing strength right now, but this pattern is usually bearish. So things to keep in mind.
It shows you manufacturing starting to get go.
Yep. And then gold has had a huge spike off a triple bottom, and so what this is telling us is that people are getting defensive and they're starting to put their dollars into gold as a way to hedge and protect themselves from downside risk on the dollar, downside risk in equities or other asset classes.
And also to keep it's a hedge against inflation.
Correct. And then here we got the crude chart. So this is the oil chart on a weekly, and it's essentially been trending down. There has been some good trade opportunities in this chart that we called privately in our private Discord group. But right now I don't know if the Fed is, or the current administration has come out and said that they're buyers of oil to replenish the petroleum reserves that they destroyed over the last few years. And you can see it's down 30% of our strategic petroleum reserves for the country is down 30-ish%. That there are buyers of this at this red line, roughly around the 70 level, which is a 4.4% move. So it's almost like a free trade.
Yeah, they also, the reserves, that's what they tried, again, the government tried to do to alleviate inflation, for a lot of people this last year, to sell their inventories to keep prices lower. That only works for so long, but, look at the trade that they made. They were giving it away at the top and now they're buying it, at the bottom, refilling. I mean, it's a good money trade.
So, fill up your car in the next the next month or so. Moving on to stock markets. Oh, did you have one more comment on that?
No, that's good. Again, just commodities is another asset class that is taken away from it's competing with crypto, with stocks, with bonds. Again, that I bond, the government, it's all competing for your dollars now. So that's even driving liquidity up even more. And that's still in the system, what's left in the system. So
yeah. Quick comment on I see in the RH post put in here, electric cars equals no gas. It almost makes too much sense. That does make sense if the commodity prices hadn't rise to the point where it costs 2.5 times as much to produce a Tesla car now than it did 2 years ago. So it actually costs you more in oil and industry to build those vehicles now, and in lithium, and in whatever other components that goes in there for the batteries and whatnot. So it's a trick. It's like it's a big trick.
The sum of the parts is probably more toxic and costs more than the finished product. Yeah, it's interesting. Europe's looking to put a tax, like almost a pollution tax on China for any of their copper exports. So it'd be interesting to see, because people are trying to save the world. So again, technologies are changing. But
yep. So here we go with the stock markets. So this chart is it's an indice of indices. So I combine the S&P 500, the NASDAQ, the Dow Jones, and the Russell together into one chart, and you can see that the markets have recovered off their low, which would happen to be the high in 2020 before the COVID crash, and it just bounced clean right off that level in the red dotted line here. And so we've had a nice rally since October all the way up to this level here, where we literally all of these markets together have bounced out and are kind of trying to find some sort of support above this the level in the yellow.
The S&P is actually from October 13th to December 6th. We were in a nice trend up, and then we just broke it. And
like Bob's been calling this move on the S&P for weeks privately, and he had the 4100 level as a key level. Obviously, this was the fourth touch of this upper trend line, and there's a clean rejection off.
Yeah, the actual high was 4110.
So it was a beautiful call, and it was and technically it traded perfectly. And so what we're looking at when we look at this massive index of indexes is we're trying to figure out, where did the weakness come from and where did the strength come from? So then when we look at the Dow Jones on like a 100-year time frame, this is your industrial America. This is like the power growth of the last 100 years of growth in the stock market, right? Before the technology, before the NASDAQ, before the S&P and these things. And so we're playing with this middle dotted line now. It's oscillating up and under this line over time. So it almost looks like it's coming back in for a nice little undervaluation period, which would actually just be a rebase period to come back to the mean. And then when you look at the Dow Jones itself, it performed best out of the 3 stock indexes that we'll look at. It got above this descending channel and is now trying to form some sort of support off these key levels here at the 33,000 level. And then contrary to that, you had again, we're looking at the S&P, as Bob had noted earlier, that fourth touch of this upper trend line and then a rejection means some sort of weakness is coming in on that, but that it might not be the biggest weakness. And then we'll get into our third point, which is the NASDAQ, right? So the NASDAQ could not even, this is your tech stocks, this is your non-bank financial institutions, so like insurance firms, venture capitalists, currency exchanges, FTX, some micro loan organizations, and pawn shops. These non-bank financial institutions provide services that are not necessarily suited to banks. They serve as competition to banks, unlike HEX, and specialize in sectors or groups. Now, this index has not even got above its easiest descending trend line to get above it or to even test it. And so what this is telling us is like this is where the fallout is going to happen in these stock markets.
And the other the other interesting things I observed was that if this Friday we close in these levels in the S&P on a weekly basis, we'll have closed below that channel since the rally of October. And if you look at the VIX, that actually has been in a bear slam. Yeah. And it's actually going to have its first green candle in quite a while. So again, there's opportunities that are presenting themselves. We're at year end. The Christmas rally looks like it failed a little earlier, but a lot of stocks were up 25, 30% from their lows, still down from their highs. Like Mitch had said, the triple Qs, that's an industry that I think is going to get punished. They're going to have the highest job losses in that industry. I personally experienced that in financials in 08 with technology, and just the cost of your profit margin goes down because it becomes, at some point, this technology becomes a utility because it's standardized, like the internet, so that's what's happening with technology. Unless you innovate, it kind of becomes just, again, conduit, and it loses its value. It's based on units, not so much on appreciated value.
I like this comment here by Believe in Yourself. And Bob, tell me what you think. He says, absolutely every industry working towards the most efficient and least harmful, even restorative, isn't always the most profitable, but growth can be painful.
Exactly. But, the big thing is, over the last few years, there's been an initiative with corporations about this green, and there's even indexes about it, this green, I can't remember what it's properly termed, but it's basically, you'd have funds that'll only invest in companies that have, they give X amount towards green causes, and it was a big business, but they also think it was a scam because like that, that member just commented, it doesn't make sense, and people realize that, and they're losing money, and it just,
yeah,
I don't know, but
I think the big obvious thing for me with it looking at tech stocks, like Meta, Google, Apple, and then like them competing against which is now cryptocurrency, which is deleting middlemen day in and day out, like it's its day job. Like it just makes sense that you're going to see a huge reduction in valuations on those assets because they just don't provide the value.
I love the way you put deleting middlemen. I never heard it phrased that way. I like that.
I have been kind of trying to keep up with the chat here, and there's some good stuff. So I can't wait to answer some of your questions here as we get into crypto. Yeah. So like here you go. We just saw weakness on the NASDAQ in this chart. So, I think crypto also applies in either the crypto businesses that are built around it that have to liquidate crypto in order to cover their losses and stuff like that, or otherwise just the crypto themselves. They in themselves act sort of like currency exchanges or some other form of non-bank financial technology, right? So as we look towards the May 2024 2024 Bitcoin halving, you can see here in the yellow dotted line, there's nothing saying that there isn't another leg down in store for the total crypto cap. I mean, like, it just would make sense that this is a long 2-year base out period where we start to try to build some decent, new entrepreneurial spirits comes into the industry and builds a base on the things that are going to live into the future, and the things that are going to die off during this time frame. Same as we had in 2015, same as we had in 2018, same as we had with like the COVID crash. But those that recovered screamed to crazy high prices. A lot of us benefited from that in this last cycle. So, if you're looking at a time frame, I'm thinking that the next year and a half could be volatile, but very profitable for those that take opportunities below the 800 billion market cap level, which also coincides with the 2017 high, yellow line here. I guess this is where we can shift into crypto. And RHMax, if you want to like lead the charge on questions and charts you want to see.
Yeah. Did you have any prepared already, or like, is there an order I need to go in, or should I just?
You can go in any order. Of course, I always like to start with HEX.
I think there's no better crypto to start with. Let's do it.
We got here HEX on the 3-day, and I've brought this chart up now multiple times over the last few streams I've been on, because this is a 3-day chart. It's showing you data all the way since the top. The price chart is in this giant descending channel, same as a lot of the charts across all asset classes right now, and it got rejected off the high 3 times, and then now we're starting to build support down here, which gives us this, if you see here in white, the falling wedge. So if I delete this out, you can see cleanly there's a falling wedge here, and this is a bullish pattern. So what happens is the amount of coins that you could sell at 10 cents to drop the price lower, it takes 5 to 10 times more now to drop the price the same amount as it did back then. So in other words, if you sold 100 million HEX at 10 cents, you have the same effect now. You have to sell a billion HEX in one market press, and there's just not that many participants in the system with that kind of quantity of HEX that's willing to dump at these prices. And that's effectively why you're starting to see volatility in the chart decrease and downside decreasing as well. And then the price is effectively getting squeezed into this channel or up to into next spring, and eventually which will lead to a breakout and then eventual continuation higher. This thing does have product market fit. It's backed by some of the biggest names in crypto, multi-billionaire people. There's $6 billion locked up in stakes. So it's here to stay. The code can't be changed. The code can't be shut off. There's a lot of things like that makes it a sure bet going into the next bull run. And your opportunity zones are, anywhere below these levels down to sub penny are good buying opportunities when you're looking at this on a 5 or 10 year time frame. There was $13 million day of volume, which is a good day for us on HEX. Usually it's like between 5 and 7. But here you can see that down here in the volume bars that they trend down, and then you get a spike and an injection of liquidity, and that's when you get the run-ups. Then they trend down, then you get a spike in liquidity, and that's when you get these run-ups. This was an 80% run-up.
What's the timeline?
We're looking at a 3-day chart.
So how many hours then is? You know how you just measured those spikes, the volume spikes?
Yeah, so these spikes happen. Like, so for example, this one back in when was that? December of last year, we spiked up for 18 days and we saw 182%.
But what was it prior to that? What was that distance? Remember you angled?
Oh,
yeah. What's that timeline? Because it looks like it's unison. That one and the other one looked before each spike.
Yeah, so this is like 90 days of volume decreasing. This is about 111 days of volume decreasing. This is about 63 days of volume decreasing. So the amount of time that volume decreases is shortening, so there's less time between pumps.
Yeah.
And so effectively now we're at, when was the best time to buy Bitcoin? Richard Hart always says that. Well, it's when the volume was the lowest and it was the hardest to acquire. Well, now volume is now getting to the lowest it's been since April, before that run up that took us up 89% from 11 cents to 20 cents in 15 days, and it was for an 88% return. So we're just going to fall, squeeze into this wedge, squeeze, 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 and all the opportunity you can see on the RSI down here is
Yeah.
below this key level here of 40. So when the RSI gets into this band is when you want to be looking to make your decision.
So from the last, basically, and again, if you used around 90 days as the average, that's from the last pump. You just measure out, and that's probably close to 3/4 of the apex.
If you get 90 days out from here, and the price stays flat, you're going to break out within 60 days. You need downside action.
No, I meant the side from the resistant line that's come to 45 coming down.
Yeah, you're 90 days basically. So the price and time, you'd be looking at 2-cent hex by March 5th, and that would be the bottom, and you'd get some massive squeeze out of here.
And that's the other thing, really. There's two elements to charts in, again, my studies, is price and time, and the most important is time. So again, WD Gann is another great guy to go read about. Amazing studies of markets and what he uses, from astronomy to waves. It's interesting.
Here you can see the full hex chart, and you can see like hex ran up 25,000% in 300 days. So now we needed time to blow the steam out of the engine. So we've been trending down for 455 days. I say you double that, so 600 days puts you at, May. So like again, coming into next summer, we should see a breakout above these resistance lines. No crystal ball, but if that were to occur, you'd be seeing price action above 4 cents, 5 cents by that time frame.
I think you're going to get a lot of bad news the first and second quarter next year. So again, that falls in line with that time frame.
Also, the other thing to keep in mind is just simple price structure. So if I draw that line and I draw this line, these are the levels that are going to be protected by where most of the time spent was. So there was 150 days spent between a half a penny and 2 cents, and we spent another 230 days, right below that, from like 0.003 to 0.002 to 0.006. So to break these levels would take a tremendous amount of selling and force. And I can't say too much beyond that because I don't want to compromise what's going on, but just that a lot of the hex that was risky has been sold off. Most of it in this giant dump here. So, calculated risk, people. About as much as I could say for now on hex. I don't know, RH, if you want to see like a price targets for the next bull run, maybe. Or that's kind of exciting.
What we keep saying are, people, you haven't missed anything yet.
Yeah, you're early still.
Yeah, we had a couple questions on hex.
Okay.
Things were around what's the better thing to put in money today, hex, Hedron, Icosa, stuff like that. So we can just hit some of the charts you can talk about.
That's a great question, though. I like that question, and it's relevant to what we're talking about here, which is, if you're coming in with no exposure to cryptocurrency or little exposure, I'm talking like less than 5 figures, like where do you put your money? Well, it kind of depends on what your strategy is. How long are you in this for, and what's your strategy? So in my opinion, this is just an opinion of what I'm doing if I'm new to cryptocurrency. Well, I would always encourage myself to stake a ladder, because then I can hedge any kinds of losses on the asset by the returns I'm getting back in the coin over a 5 or 10 year period. So I'm basically saying that this thing's got product market fit. It's going to be here a while, and I'm going to be able to earn 25% more, 30% more coins every year over year. And within 3 years, I'm going to have double the coins I had. So that means the price would have to fall 50% or more year over year for me to be suffering. And at these prices, when hex is up 43,000% off the low, or 50,000%, and it's down 94%. It's at that sweet spot right now where, like I said before, the downside's limited, upside is nearly unlimited if it's competing with banks. And so then, but then you got to look at, let's go into the Hedron chart now. There's a couple things that are very interesting about this chart and a couple alpha points that I've dropped in the last few days. I think Hedron's undervalued personally. You know, I purchase it at these prices because I recognize that, I mean, we're at the launch price for Hedron. So I'm going to pull up a tweet that I made the other day. And it'll should be very clear when you see it. So this chart shows you HEX in pink and Hedron in purple. Their launch price is 1. And so Hedron has oscillated under and over this line in a 30x range. From the low to the high, that was 30 times. And so it's oscillated this range for, see, let's check the time frame. From the beginning till now, 284 days. Well, we all know what happened to HEX in its first 364 days, and we're only 280 days in. So for me, I still see Hedron as a huge opportunity at these prices where you're basically at the starting price. That, you know, I would put some of my, like if I'm buying for myself, I would do some in a ladder, and I'd be buying some Hedron as well. That's just me. Icosa is a unique
very unique
chart
I
in
was
and of
trying to get
itself.
Sloth and some other folks to talk about some of the fundamentals and why that's playing into the price action too, because it's looking different than it was a month ago. But you know, I think it plays within the system of how it works as well.
Yeah. So Icosa USD has $200,000 liquidity in here, so it's a decent sized pool, and potentially, you know, Sloth pointed out to me this morning that this could be setting up for some sort of a triple bottom, something like this, and it is making a higher low as of right now. So on the dollar chart, it looks better than against HEX. So when I pull up Icosa HEX, it looks a little different to me. But it's not necessarily a bad thing. If I can find the dang thing. So it broke parity. Like it was basically within this range for basically since it started. It was holding this basically this trend here where it was more or less just oscillating inside of this level here, right? Hold on, my computer is dying right now. Okay, so it was basically in this uptrend for the first 90 days, and then we had a major sell-off. And so what I was telling people in the private group was there would be a potentially opportunity down here at this red line, which was the wick low on this sell-off under low liquidity conditions. And so relative to HEX, it's lost valuation, but relative to the dollar, it's in an uptrend technically right now. So there's only $34,000 liquidity on this pair. There's like 200,000 on the USDC pair. I do see it as finding support here soon. And so it could be a tremendous opportunity below this red line or around it. And back to Hedron. I know I'm jumping around a lot right now, but the Hedron chart against HEX. Hedron against HEX. This is a key chart to watch. Here I have in blue, I have the OA wall. So this is basically where the liquidity will show. I'll show you the liquidity for it because it's key to this understanding is. Okay. You can see here that most of the liquidity down here is sitting with like, you know, much less coins than where this huge OA wall was. This is where the this wall represents where the OA put a bunch of HEX to stop price from moving higher. But then when Hedron had its 30x run up off the low, it broke through this wall and it started to move. It moved Hedron price up in dollar terms and against HEX. And that's what this chart here is describing to you is when the OA wall was put into place, it was put into place here and created a cascading down of valuation against HEX because people were able to take huge profits because those HEX were into HEX at that time. But then we had the run up in anticipation of the auctions. And this major price action happened to get us out of the OA wall and got us way above it so that the second wave of selling could occur. And so now we're just reverting back to the mean where all of the huge bands are. And so if you're a pro Hedron and you have a lot of HEX or you have a lot of USDC sidelined, the place to accumulate would be somewhere in this band, which is somewhere between 20,000 hex per hedron, or 20,000 hedron per hex, or 25,000 hedron per hex inside this band. So there's still potential downside here, but ultimately it will catch in USD terms. It's still at its launch price. So effectively, I do anticipate that Hedron and Hex will take turns leading the charge. Right now, Hex is in charge, and Hedron took the back seat. But for a time, Hedron was in charge, and Hex took the back seat. So I anticipate that over the lifetime of this chart, that as Hex goes up in price in USD terms, that Hedron will track it just in the same way that it's tracking the T-share rate and the inflation rate as Icosa is, and they're all tracking essentially the value accrual in the form of the T-share, which is ultimately the same in the same way that how monetary policy is driven by the Fed in their system. So they're just different financial systems. That's a good way to look at them neutrally, and they're all good opportunities at these prices. Bob can attest.
Do you want to look at the
Questions?
TLSD?
Yeah, no, I'm sorry, I had my mute on.
Oh, sorry, Bob. Yeah, go ahead.
Still
Yeah, we
moving.
can look at PLC.
No, I was just going to say, when you were talking about somebody coming in for the first time, I'm telling people that have got in and paid higher prices, these are the points in which you have, and I personally have been accumulating Bitcoin and Ethereum at these levels. My background is, I got into Bitcoin, just to give you some background on that. In 15, I purchased about Bitcoin for about $4,000, and I dumped it at 60, and now I'm just getting back to buying. So I'm dollar cost averaging in these levels now on Bitcoin. Ethereum also is actually more exciting. It's actually, I think, holding up a lot better. Again, because the technology that's driven under it's the main. I think it's more applicable to the technology than Bitcoin. Bitcoin's almost like a collector's item to an extent. But yeah, these are the areas. Again, I'm still looking. You're not late to the event, but if we got to 12 on Bitcoin, it's not going to be there long. And same thing if Ethereum could have already made, their lows around that 835. So again, it's just, being able to dollar cost average. You're not going to be picking the absolute bottom, but over time, I think, again, 2025 is where I think, again, the imbalances of the economy, the recession, and everything is you're going to be able to see things going forward. But until then, we're just going to be, again,
it's a buyer's market down here. Like if you're
Yeah.
fearful and you're selling, you're on the wrong side.
Because if the dollar is truly what what I perceive is it's reached its peak, then I think those assets that have gotten clobbered, nobody knows how to price them, because in the end of the day, this is what's happening. People are pricing in assets valued, including whatever the average cost of money is now. It's been zero before, so this rebalancing is what's been brutal, volatile.
Bob, check out the 6-month chart on the dollar here. Like this, look at this candle that just printed. It's printing. It's got 23 days to close. This is a 6-month chart of the dollar. This is one of the most bearish. If this candle prints like this, I don't see another chart on here. Oh, here's one, and it had follow through.
Yeah. Like I said,
down.
I've been long the VIX about 3 days now, and that's another chart. It's been, just dog.
So we think that the dollar is like toast, and that this is going to be a 1 or 2 year growing period. And I mean, before Bob, I'm going to come back to Bitcoin and ETH in a second. We don't got a lot of time left.
Go ahead. Go.
I got to talk about Pulse Dogecoin here for the peoples, because it did have a key breakout of this downtrend resistance, and it went up and tested the 0.786. Now, I drew this double bottom in here again in the private Discord. I gotta shill my bags, because we do a lot of good work in there, and I daily updates. I'm doing them multiple times a day. We called for a test at the top of the trend line here, and it broke and then came back in. And I'm pretty sure I had a RS. Okay, and that's not the same. But anyway, so we tested the 0.618, which was what I thought was going to happen. And then I thought we'd get a rejection. We didn't. It continued. And what it continued on was hype around the ASIC token here, which had a key breakout, and Pulse Bitcoin, which also had a key breakout. And now they're on huge tears. So these are all their own little mini ecosystem that are moving independently of the entire market. So now I guess we can go back into just a quick comparison of Bitcoin. I want to show you this chart first. I'll show it to you on the monthly. I mean, you can see here Bitcoin over its entire lifetime in this giant logarithmic growth curve. And if you just took the bottom at, like, let's say, like the 13.7K top from 2019 summer, and get us down to that level, and then start to create some sort of a bottom off this bottom blue growth curve, then you'd be trading between 20,000 and 36,000 sometime going into 2024, and then building structure, and then maybe sometime midsummer 2024 we finally start to make our ascent for the ultimate bull run, which would come in 2025, with those targets based on previous fractals landing dead nuts between these right above the midline here of the channel of the trend, somewhere between like 90,000 and 120 per Bitcoin, and within 3 years roughly. And that's under the circumstances that the Fed changes their pivots and changes their stance. Money becomes a little more accessible, and things start to change that way. Now, interesting also with that is the Ethereum chart. It's looking much better. I mean, we all understand that Ethereum is where all the value is. All of our favorite assets are built on Ethereum. We use it as a utility, but it's also now deflationary, so it's got long-term viability. And it's nothing proves that more to me than when I look at the Ethereum Bitcoin chart as here. So when you look at the Ethereum Bitcoin chart, since it bottomed in September of 19, it's up 350% against Bitcoin. And it's been able to hold that level now for 580 days. So Ethereum is where, like, if you go back to the first break up here, HEX launches on December 2nd of 19, which is here on the bottom. And then you get the run up. And then, that next summer, DeFi summer, Uniswap gets launched, July of summer of 2020. We have another pump against Bitcoin. So as things of value are being built on Ethereum, Ethereum is gaining in long-term value prop against Bitcoin. Bitcoin's literally just dumb rock crypto now. It's going to be a $1 trillion asset class that the legacy guys can have fun making 3% on every couple of years, and it's or 3x on every few years. So it's fun for them because it's got trillions of dollars in it. But for us, the potential and the opportunity is going to be in the better technology that things are being built on top of.
Exactly.
Gentlemen, it's been fantastic. There a small queue of questions here that I'd like to get into before we wrap up, though, because I got a hard stop here in just a few minutes.
Okay.
You guys mind let's do rapid fire.
Got it.
A few ones from the chat that I wanted to address here real quick that are some are chart related, some aren't. But let's see. I'll go with one of the community ones I want to make sure I get to is the T-shares projected rate, where HEX goes from here. What's your 60 seconds on where HEX goes from here with considering T-shares and the current action?
With T-shares? I think T-shares just went deflationary, and I believe that staking participation will fall slightly, because I think people are going to be selling into the pumps coming into the next bull market. So I think T-shares will trend down, APYs will trend up. But that's just all speculation because I can't predict, what the T-shares are going to do. But what I can do is if we take this curve here on hexfire.io, you can see that the T-share rate is going to increase. Based on if each stake was to end on time by 2038, it would cost 131,000 HEX for a T-share, and that's at this price. So it's about a 5x in dollar terms cost. Now, if you compound that against what price appreciation it can do, T-shares will be a thing of the past. Like, you won't be buying T-shares anymore. You'll be buying B-shares, which is just 1 billion shares. So, I mean, ultimately, short term, HEX goes sideways, squeezes in price, and then pops out the top. And by next summer, maybe we can go test 10 cents.
Nice. So somebody asked, I think when we were doing the technicals too, top of the next bull is Q2 2025? Question.
I see that as a possibility. Yeah, definitely. Just based on the log growth curve of Bitcoin that I showed here. It's showing somewhere between April 2025, November 2025 into December.
Wow. Okay.
Subject to change, of course.
The best coin to hold for the PulseChain airdrop. What do you think is going to be worth anything?
Ooh, tough one. I'm sounding like such a shill because I think it's HEX personally. I think that one's the for sure upside. And you don't have any stablecoin risk, and you're not holding ETH, which doesn't transfer well over to that chain.
Yeah. Hex forks, ETH fair. Any action going over there? Is it all dried up, or is it just something
people will definitely play the low liquidity game over there, and like 10 grand they'll pump the chart 4 or 5x, and it'll be a game of swapping coins back and forth for a while, ratio trading. But whether or not those things take off long term, I really can't tell you. But I do see that there's a possible value proposition there if regulators come under fire in some way on ETH proof of stake or some other fundamental situation happens that I can't predict. But I'm personally not involved.
All I'll predict is there will be regulations after FTX.
Yeah, that is the fuel for a fire for sure. Just two more real quick. It's something I saw when we were doing the money supply. If demand is shrinking, where's the money going? It's staying on the sidelines. 2023. Axis mentioned the money is dieted, something like that. Dieted.
Well, the whole thing is the government has again debt maturing every day that it issued years ago and stuff. And when they were in the game, they'd issue new debt, so they create liquidity. So what they said a few months back is they're not only going to, stop issuing new debt, that they're going to let the debt that they have on their books fall off. So they're not adding that currency back into the market. So again, they're draining the liquidity, and that's a way of trying to reduce their book
that makes
by
sense.
letting the debt fall off. But again, it's what it's doing is it's getting rid of liquidity. So you're starting to see that back up in the debt market. That's why you got an inverted yield curve. Again, the economy's not working right. The Fed basically has stopped being in the game. And that's what's interesting, because these I bonds and the other one are tips. They're all tied to inflation. The amount that the Fed has to pay out in obligations, they're not generating cash. So my question's always been, where's their liquidity? I mean, they got to provide for the people that bought these debt instruments the interest that they're due. Especially
they do have an $8 trillion balance sheet, right? So they're taking away from their own balance sheet to get rid of the debt part, so that it lowers liquidity, so there's less money to lend.
But the problem is their obligations on those inflation debt that they've issued is like, I think it's a ridiculous number, 9 trillion. I think. Where are they getting that money from?
They would have to print, right? Theoretically.
Yeah, but they're not printing. That's what I don't understand.
So at some point, the switch would flip. And also add with that yes, there is money sitting on the sideline in the form of stable coins, and that's represented in my stablecoin index chart, which I have in front of you. That's USDC, USDT, and DAI. And so we are at nearly all-time high stablecoins in market cap in the crypto market. At about 15% of all crypto is stablecoins, just sitting on the sidelines waiting to be injected back into the real cryptos.
Okay. One last one before we get off here. The question was, when PulseChain testnet v3 comes out, do you expect HEX to pump into PulseChain launch? Is there anything around that makes sense?
I will say that I'm pretty confident that only the PulseChain launch release date will pump the price of HEX, but that I wouldn't rule that out.
Interesting. All right, gentlemen. Fantastic show today. Let you guys have the last words. Axis Contrarian, what do you want to send us off with?
Well, I just want to say thank you for letting us talk on your program. You got a great setup here. I appreciate it. Again, anytime anybody can work together in a community, it's a good thing. So thank you.
Yeah, of course. I appreciate you having coming on and going over all this stuff.
Yeah, and Max, thank you so much for letting me invade your space today and drop a presentation out of the blue, and also to the chat for being involved in the conversation. I really appreciate that. And tonight we'll be doing another show with Randy Hilarski. We'll be going deeper into the that presentation and adding and going into a few more slides, but also just kind of rehashing what we went through this morning. But
this
thank you,
is
everybody.
the compressed version, the hour and a half version. I'm glad we could get it in, and know that you guys can invade anytime you want, man. You always bring the people. We got 150 people watching. I think they're happy with what they got today. They got a good deal.
Awesome, guys.
So
cool.
Oh yeah, AxisAlive.com is coming soon to a website near you, to a screen near you. So probably end of month or into the new year. So it's coming along well.
Happy holidays.
Contrarian, is there a place you have any links or Twitter or anything you want to share with anyone to follow you?
Right now, you can just go through AxisAlive.
Perfect. Yeah, we'll have a section for him, so you can email him on the website when that goes live.
Awesome. All right, thanks, gentlemen. We are out. We got a show again. Go watch Contrarian and Axis on Randy's show a little bit later today, and then we got the next show. If Sloth doesn't come on and talk about Icosa, then we got a show coming up Friday with Crispy Man with HEXFire.io that Axis was on earlier. And we'll be talking about some very interesting stuff on HEX and break down a few concepts on that as well. So thanks, everyone. Smash all the buttons. I appreciate it. And we are out.